Chapter 10, Stockholders' Equity. The learning objectives. Number 1, explain the features of a corporation. Number 2, account for the issuance of stock. Number 3, explain how treasury stock affects a company. Number 4, account for retained earnings, dividends, and splits. Number 5, evaluate a company's performance using new ratios. Number 6, report stockholders' equity transactions in financial statements. Learning Objective 10.1, explain the features of a corporation. First of all, the first bullet point says we have a separate legal entity. The next bullet point says continuous life and transferability of ownership. What that means is that the entity continues without regard to the ownership. So if you own stock in that company, you are considered to be part of ownership. If you pass away, well, that stock transfers to somebody else. Meanwhile, the business continues to exist. The third bullet point says limited liability. That means the ownership of the entity, the shareholders, are shielded from liabilities affecting specifically the corporation. So if the corporation defaults on a loan, the shareholders are not held accountable for that. When the corporation decides to acquire a loan, a bank or lending institution or whoever it may be issues the loan based upon the integrity of just the company, not the owners. So you can buy stock in a company and not worry that somebody's going to come after you for your personal assets. The fourth bullet point, separation of ownership and management. If I own shares of a publicly traded organization, such as Microsoft, I am not part of management. Just because I own shares does not make me part of management. So management is identified by the board of directors, but there is separation. The ownership of a company is not automatically part of management. A corporation is also subject to corporate taxation, which means that it will have to pay taxes on its income just like individuals do. And a corporation is subject to much more government regulation compared to a sole proprietorship. There are specific requirements, administrative requirements that a corporation has to follow in order to keep its status as a corporation. The next slides talk about the advantages and disadvantages. The advantages is that the corporation can raise more capital than a proprietorship or partnership can. So because a publicly traded organization, a corporation, will have potentially thousands, maybe hundreds of thousands, maybe even millions of shareholders, then it's relatively easy compared to a sole proprietorship to generate cash. A sole proprietor, the amount of cash generated for ownership is limited to the sole proprietor itself. That's an advantage for the corporation. Number 2, the second advantage to a corporation is continuous life. As I mentioned to you earlier, if an owner dies, a shareholder dies, the business continues without regard to the owner. The shares pass on through the will of that individual that passes away. The will dictate who then obtains ownership or who begins to own the shares. In contrast, if you have a sole proprietorship, if that sole proprietor dies, then that company, as it exists at that point in time, dies as well. There's no longer, that business no longer exists. Number 3, ease of transferring ownership. The fact that there are stocks that are available to be bought and sold for anyone makes the corporation easy to transfer. So in that respect, definitely advantage for the corporation. They can transfer their shares and ownership to anybody. Number 4, limited liability of stockholders. That's a very nice blessing for those who buy stock. They recognize and understand that if the corporation defaults on a loan, or if the corporation is sued by a third party, the owners are shielded by the limited liability bail, so that they don't have to worry so much about their personal assets being at risk. Now, there are some disadvantages of a corporation. Number one, separation of ownership and management. The separation of ownership and management may be viewed as a disadvantage because there may be a difference in priorities between management and ownership. Management might be motivated to make sure that the employees are paid, bonuses are issued, but remember, if a bonus is issued to the employees, then that's less money to the ownership. Number two disadvantage is double taxation of distributed profits. The corporation is taxed just like any entity. Now, after it's taxed, it finally ends up with a net income after taxes of X amount of dollars. If that net income after taxes is then distributed to the shareholders as dividends, then the recipients of those dividends, the shareholders, will then have to report those dividends on their personal tax returns. So when we refer to double taxation, we talk about how a corporation makes money. That's the only way it can distribute dividends, is if they make money. And then when they distribute that income to shareholders, they will have to pay taxes on that net income. And then when they distribute the remaining net income that's already been taxed, when they distribute that remaining net income to the shareholders will then have to pay taxes on those dividends. And so that is the explanation for double taxation. And then disadvantage number three, compared to a partnership or a sole proprietorship, a corporation has to follow many more regulations, many more administrative processes and procedures. So when and if a group or an individual decides to form a corporation, the first thing we have to do is organize it. In organizing a corporation, a group of corporate organizers will get together, and it doesn't have to be a group, it could be one individual. But organizers will come together and they would create a charter for the state. They would submit the charter to the state, and that charter authorizes corporations to issue a certain number of shares of stock. The incorporators, those who come together, will pay fees, sign the charter, file documents with the state, and agree to a set of bylaws. So it's a bit of an administrative process. It's not a death sentence, but most people hire attorneys to help them gather the documents that are necessary for incorporating. A typical structure of a corporation starts off with, at the very highest level, stockholders. These are individuals just like you and me who decide that we want to invest our money in a particular stock. Once we purchase those stocks, we will be considered to be shareholders. Now, the shareholders then can participate in the election of the board of directors. So think of it in the context, if you're a citizen of the United States, you get to elect your representatives, the House of Representatives, your senators. You participate in electing them. Similarly, the shareholders or stockholders elect the board of directors. Now, the board of directors then elect the chairperson of the board, or the chief executive officer. So the board of directors have quite a bit of responsibility in making sure they identify the right leadership, the right management for the company. About here is where we start talking about management. Board of directors are really answering to the stockholders. Here is when you start talking about employees, and the first employees at the highest end is referred to as the CEO. The CEO then identifies a president or chief operating officer, and then the chief operating officer identifies vice president for the various areas, including sales, manufacturing, finances, which is referred to as a chief financial officer or CFO, human resources, and then you also may identify a secretary. Under the chief financial officer, this is obviously an accounting course, so we're going to focus in on the financial aspects of a corporation. Under the chief financial officer, you will identify a controller, who is the accounting officer, and the treasurer, who is considered to be the finance officer. Continuing with explaining the features of a corporation, if you purchase a share, you are a stockholder. And as a stockholder, you have specific rights. As an example, one of those rights are to vote. You have the right to vote on matters that come before the stockholders. Not every matter comes to the stockholders, just like not every matter comes to citizens. In many cases, the House of Representatives, the senators, take action and do not bring these issues to the general population. You voted them in to take care of issues. If there are extraordinary things that need to be addressed, then many times those actually come to citizens. But for the most part, you vote in those representatives and they make decisions. So that's what a stockholder has the right, is to vote on matters that come before the stockholders, mostly voting on the board of directors. The next stockholder's right is dividends. The right is to receive a proportionate part of any dividends. Dividends are declared by the board of directors, and if you're a shareholder, you have the right to receive those dividends. In the event of liquidation, and what that means is that the corporation is in a situation where they're closing down, they're liquidating, which means they're selling everything, including inventory, property, plant, and equipment, everything about the corporation, they're just getting rid of it. So if that's the case, then when the corporation closes and liquidates itself, then the shareholders have the right to receive a proportionate share of any assets remaining upon liquidation. And the final bullet point says preemption, and that is the right to maintain one's proportionate ownership in the corporation. If you own 50% of the shares and the board of directors decides to issue more shares, you have first rights to buy 50% of the new shares so that you maintain your 50% control. Again, continuing on with the features of a corporation. The stockholders' equity section of the balance sheet includes paid-in capital, or sometimes referred to as contributed capital. And these are the amounts of stockholders' equity the stockholders have contributed to the corporation. When a corporation is first issued, or when the corporation is first created, then there's an initial public offering. The corporation sells immediately a whole bunch of shares to the general public. And the money that's generated from those shares that are sold immediately really becomes paid-in capital. Paid-in capital also includes stock accounts and additional paid-in capital. Stock accounts we'll learn really means what the par value is of the stock, and then any additional paid-in capital is money paid to the corporation for the purchase of stocks that exceed the par value. We'll learn more about that in a few slides. Still talking about stockholders' equity, where the next section is called retained earnings. Retained earnings is an amount of stockholders' equity the corporation has earned through profitable operations. Now, we have to be careful here. It's money that's earned through profitable operations, but has also been retained. In other words, when a company earns money, it has options. It can take some of that income, that money, that earnings, and distribute it to the shareholders as a reward for their investment. Or it can retain it. It can hold it so that the corporation can then turn around and invest in itself even more, buy more property, more equipment, and more assets so that it can continue to be profitable for the shareholders. So when we talk about retained earnings, we're talking about the equity the corporation has earned through profitable operations, but retained earnings will be reduced if they pay some of these earnings out in dividends to shareholders. So retained earnings is income less dividends paid out. Here's an example of what you might see for a company stock. The par value will be listed, the name of the corporation, addresses, and a lot of information there. Most of the time when you purchase shares, you probably won't even see these certificates. They are often held by brokers or financial institutions. Rather than issuing them out to all the shareholders, they just maintain them in their secured areas. There are different classes of stock. There is what we call common stock. And as the name suggests, common stock is most common. It is a basic form of stock. The owners of the corporation, and you have 4 basic rights as a common stock shareholder. We'll review those rights in a future slide. And so a common stockholder stands to benefit most if the corporation succeeds. You also have what are referred to as preferred stock. You have certain advantages over common stock, such as you receive dividends first, and you also receive assets first in a liquidation. You have 4 basic rights as well, but preferred stock is rare in practice. You don't see a lot of preferred stock anymore. Mostly common stock are issued. Now, when we're talking about financing a company or corporation, that financing can come in one of 3 ways. Common stocks, which is what we refer to. You can also sell preferred stock. The company can also issue long-term debt. Ways that we can compare the 3 of these 3 finance alternatives. Number 1, the obligation to repay the principal. There's no obligation in common stock. If you buy common stock, you bet on the fact that you'll be able to sell it, and when you sell it, your principal or your original investment is returned. You're hoping as well that not only do you get that original investment back, but you get maybe some appreciation. Same with preferred stock. There is no requirement that an initial purchase, which would involve the principal, that the shareholder receive that money back. However, when it comes to the issuance of debt, there is an obligation for the company to repay the principal along with interest. So you can see from a company perspective, we might be inclined to choose common and preferred stock before debt because there's no obligation to pay this back. Number 2, dividends and interest. Common stockholders receive dividends, but they are not tax deductible for the corporation. So when they pay dividends to shareholders, there is no tax deduction. Preferred stock, same tax, dividends are not tax deductible, so they can pay dividends to preferred stockholders, no tax deduction. Long-term debt, however, when interest is paid and the interest expense that's incurred by the corporation, that interest is tax deductible. And then number 3, obligation to pay dividends and interest. There's really no obligation for the stockholders to receive dividends. The obligation only exists after the board of directors declares it, but before, they have no obligation to declare it. So only after the declaration does the common stock shareholder have a right to receive dividends. Same with the preferred stock. Only after they're declared is there an obligation for them to be paid. However, when it relates to long-term debt, all interest applies to debt. Interest must be paid back. There is a guarantee, it is an obligation, a legal obligation for the company to pay that back. And there are different classes of stock, including par value and no par value. Par value, other than the accounting issues related to it, are really almost insignificant. Par value is an arbitrary amount assigned by a company upon issuing the stock. It's usually set low to avoid legal issues. No par stock does not have a par value. Often when you have a no par value, you may have a stated value. And again, this is rare in practice.